Hi, I'm Ken Lamantia with New South Financial Group. If you're a business owner and it feels like taxes keep getting bigger no matter how hard you work, this is for you. In the next few minutes, I'll show you how we help owners reduce taxes legally by aligning your entity structure, your compensation, your benefits, and your retirement plan design. Most high income owners aren't actually overtaxed, they're undertooled, meaning you're earning well, but you're missing the right tools and structure to keep more of what you earn. We build a custom strategy using IRS supported methods to help you deduct more, defer more, and shift income where legitimate. We can implement strategies one at a time or stack them together for maximum impact. And we coordinate with your CPA and attorney, so we add planning without disrupting your existing relationships. Here's who this is built for. If you're paying big quarterly estimates, if you have strong net income, but your retirement contributions feel capped, if you don't have a clean reimbursement plan, if your entity and compensation haven't been reviewed in a couple years, or your business grew faster than your tax planning, then you're exactly the type of client we help. This works especially well for S Corp, LLCs taxed as S Corp, professional practices, service businesses, and owners with teams, typically 5 or more employees. Before we recommend anything, we run a simple but serious diagnostic. We collect key documents like recent tax returns, year-to-date financials, payroll reports, and entity details. Then we quantify the baseline where taxes are leaking and what's avoidable. After that, we model a few compliance scenarios, conservative, moderate, and aggressive, and deliver a written plan with steps, timelines, estimated savings, and who is responsible for each part. Your CPA stays the tax return quarterback. We provide the playbook. Tax planning has 3 main levers. Number 1, deduct. Turn what you're already doing into clean business deductions and maximize retirement deductions. Number 2, defer. Shift taxable income into later years, especially when you expect lower income later. Number 3, shift. Legitimately move income into more tax-favored buckets, benefits, or structures. Big results usually come from stacking multiple small wins, not one magic trick. One of the biggest levers is your entity and your compensation strategy. The right entity depends on your margins, payroll, and growth plans. For S Corp, we focus on setting a defensible, reasonable salary and balancing distributions to reduce payroll taxes legally. For C Corp, we evaluate salary versus bonuses versus dividends and coordinate benefits and retirement design. And when it makes sense, we help separate different parts of your business, like operations versus real estate or equipment, to reduce risk and improve planning. This is one of the easiest and most missed strategies, an accountable plan. In plain English, it lets the company reimburse the owner for legitimate business expenses like home office, phone, internet, and mileage. So you're not paying those personally. When it's documented correctly, reimbursements aren't wages, which can reduce payroll tax exposure. But it must be done right: written policy, substantiation, and consistent payments. Another powerful tool is called the Augusta Rule. It allows you to rent your home to your business for qualified business meetings up to 14 days per year. When structured correctly, the homeowner can receive that rent tax-free and the business can deduct it. The key is documentation, meeting agenda, minutes, fair market rent support, and clean payment records. Documentation makes or breaks this. Next are fringe benefits, because benefits aren't just nice to have, they can be tax tools. Common wins include health strategies, HSA contributions, education assistance, dependent care, and compliant travel rules. Advanced options can include executive bonus plans, non-qualified deferred compensation, and other employer-sponsored programs. But eligibility and non-discrimination rules matter, so we design compliance first. This is where many owners leave serious money on the table. Retirement plan contribution capacity varies massively depending on the type of plan and how it's designed. The right plan can move significant income from taxable to deductible. owner age, payroll, and the employee census all affect what's possible. We coordinate the plan admin, testing, and employee messaging, so it's not just an idea, it's a system. For many growing businesses, a 401k with Safe Harbor Plus profit sharing is the best core plan. It's flexible, it scales, and it supports higher owner contributions with less testing risk. The profit sharing component can add significant deductible contributions when designed correctly. We model employer cost versus owner benefit so you know exactly what you're paying and what you're getting. If you're a high income owner and you want larger deductions, often six figures per year, a cash balance plan may be a great fit. It's a pension style plan that requires actuarial administration and disciplined funding. It works best when cash flow is stable and the goal is to accelerate retirement funding. These plans are often combined with a 401k to create a powerful stack. This is an advanced strategy, but here's the simple version. It allows key executives or owners to defer income beyond qualified plan limits. It can be customized with vesting schedules and retention incentives, but it has strict documentation and compliance rules. So we only implement it when the company can administer it correctly. 162 executive bonus arrangements. This is a simple executive benefit to understand. The business pays a bonus, and the employee uses that bonus for a structured benefit, often life insurance. The bonus is generally deductible to the business, and it can be designed with retention features. Like all insurance-based strategies, the design and illustration must be appropriate and suitable. Captive insurance is not for everyone, but in the right situation, it can improve risk management and potentially create tax advantage reserves. The important point is this: captives require real risk, real underwriting, and real governance. Used incorrectly, they attract scrutiny. So we only recommend a captive after a formal feasibility analysis. Cost segregation is a way to accelerate depreciation on qualifying real estate and fixed assets. It can create large deductions in strong cash flow years, but timing matters. Placed in service dates, accounting method rules, and future exit planning all affect the best approach. We plan this around your cash flow and financing, not just a generic study. Credits are different than deductions because credits reduce taxes dollar for dollar. Many owners miss credits like R&D, WOTC, energy incentives, and state-specific programs. Our approach is simple: quick eligibility screening, proper documentation, coordination with your CPA for forms and elections, and modeling the cash benefit versus the administrative cost. Charitable planning can also be tax planning when it's structured strategically. Tools like donor advised funds can help you bunch deductions. Other tools like charitable trusts may help in specific situations. We always coordinate with your CPA and attorney for valuation and substantiation because clean documentation is everything here. Exit planning is not something you do at the end, it's something you build years in advance. We align your entity structure, basis planning, and compensation strategy ahead of time to reduce sale day taxes. We also model things like allocations, installment approaches, and in some cases, QSBS eligibility when applicable. Exit planning is a process, not an event. This slide illustrates a key concept. Your effective tax rate is not just your tax bracket. Entity structure, compensation, and benefits design can change your real-world outcome. We look for payroll tax leakage, missed deductions, and compliance gaps. Then we document everything so your strategy is defensible. This is how we win: stacking. A few small improvements layered correctly can produce a significant total effect. We sequence quick wins first, then move into advanced strategies once the foundation is clean. Your plan is customized. This is not a template. Here's what it looks like in real life. Phase 1, first 30 days, accountable plan reimbursements, entity and comp review, quick fringe benefits, and payroll coordination. Phase 2, 30 to 120 days, retirement plan design and rollout, advanced benefits if appropriate, depreciation or credit studies, and a quarterly review cadence. You get a roadmap with deadlines, owners, and estimated impact. Here's a simplified example. Before planning, the business had an S Corp, minimal reimbursements, a basic retirement plan, and a lot of out of pocket expenses with no written strategy. After planning, we implemented an accountable plan, upgraded retirement to a safe harbor 401k with profit sharing, optimized and documented compensation, added selective fringe benefits, and modeled the savings range. The key is that everything is documented so your CPA can validate and file confidently. This is run like a project. First 30 days, kickoff, data intake, baseline analysis, projections, and quick wins. Then, over the next 60 to 120 days, documents are drafted where needed, retirement plans and benefits are rolled out, underwriting and administration is handled, and then we move into quarterly review so it stays on track. Here's what to do next. Step 1, schedule a strategy session, typically 60 to 90 minutes. Step 2, complete a short questionnaire. Step 3, send key documents like returns, payroll, and your P&L. Step 4, we deliver your custom strategy report and you choose what to implement. If you're tired of guessing and you want a clear plan to reduce taxes legally, book a call with us. The link is right here and we'll tell you quickly what's realistic for your situation. Quick note, this is educational only and not tax or legal advice. Any strategy depends on your specific facts and current law, and we coordinate with your CPA and attorney at implementation. If you're consistently paying large quarterly estimates and your CPA isn't proactively showing you a multi-strategy roadmap, you're probably leaving money on the table. Book the call now and we'll show you what's possible: clean, compliant, and customized.